All right, good morning, everyone. Sunday, 10:50 a.m., April 12th, and I've got Faisal here, and today we're going to do your weekly update on the US stock market as well as the economy. And we'll talk a little bit about, of course, the Black Swan event, which is the COVID virus. So, Faisal, we see obviously the United States has taken up number one spot in infections as well as deaths, right? And we saw last week that the jobless claims were again about 6.5 million. And then the preceding 2 weeks added up to about 10 million. So we're total about 16 million, which is about 8 to 9% of the total workforce of the United States. What did you see last week and what are your thoughts, man?
Yeah, well, good to be here, Omo. Hope you're doing well. Last week was really crazy considering some of the facts that you just laid out. You would expect it to be, I mean, going into last week, we kind of knew that it was going to be the toughest week for the country in terms of battling this virus. Hospitals were flooded. Everyone was pretty much quarantined across the board. Um, it was just a really rough time. It seemed like a different time in the country, and yet when you looked at the stock market, it was just rallying, and we ended up having one of the best weeks we've ever had since like 1932 or something like that. I don't know, but it was one of the best weeks we've ever had, and I think that's so crazy considering that maybe two-thirds of the country isn't even paying attention to the stock market. You know, they got bills to pay. There's a lot more bigger needs that need attending to, and yet the market just broke out of its short-term range. It's showing a lot of momentum, and I think based on what it showed us last week, the likelihood that the S&P can get up to around 2,900, 3,000 is pretty high in my opinion. And I still think that it's so unlikely that we go back to all-time highs, but I think that level around 2,900, 3,000, that's where you'll start to see the sellers come in, and then maybe we'll pull back from there. But this market continues to surprise me nonetheless, so it could go either way from there.
Good point. Good point. Now, I'm kind of there with you. I think I'm there 50% with you because one of the reasons why I particularly think that the market is either topped off or it may have a little bit to go. So that's kind of why I'm, like right there with you. Like if it has a little bit more to go, I think it's probably like around this, 618 fib area, which is right around that, 2,900 to 3,000 level that you talked about. Couple of reasons why I'm still thinking that this could be potentially the top. And again, it's very hard for people like us to nail the top exactly. So we always talk in defined ranges, right? We could maybe move up, 3 or 4% more. But again, that'd still be fairly close to the top if we do call it, right? So one of the reasons why I think this is the top is because this was that previous support range right here in August 2019 and then October. And if you could see right here, we pretty much hit that dead on, right?
Hmm.
And then on top of that, we hit right under that 50% Fibonacci retracement from this high to this low and then back up. So I'm thinking that as per technicals, I think we're right there, either topped off or we might have another bit of a push to the upside. But I'm fairly certain that we should be somewhere near the top. Now that's just technicals, right? My thought process is that I really don't think that the coronavirus itself, the infections, the deaths, the havoc that it's sort of wreaked in the economy has subsided. And I think that's visible in the numbers as well. I mean, obviously you're seeing a complete disconnect of the jobless claims impacting the market and then the stock market essentially just going up, right? I guess what is your take on when you start seeing these jobless claims pile up and these bad numbers or data coming across, but then you see the stock market consistently going up? How do you approach that?
Well, one thing, like when the market dropped 30%, what what did people expect the drop was for? I mean, the 60 million jobless claims, I'm sure the market priced in even more than 16 million, and I would not be surprised if we continue to move up even as those numbers get worse. I've just been so surprised by its strength, even as the medical situations are still unclear. Like mass testing is, in my opinion, halfway done. Hospitals are being overflowed, and the risk of having a second wave is, I think, still in play, and another lockdown could ensue or something like that. And to see this much buying is just, it boggles my mind. But I guess you have to go back to, this is kind of what the market priced in. When you take away 4 years of gains for a problem that hopefully by, it could be by the end of the year, we could return to 80%, 90% normalcy. It makes sense to say that the market had priced in, a lot of downside in both numbers of casualties, jobless claims, and other areas when it made that 30% drop. So that's kind of why I've kept my mind open to seeing moves like we had last week. Even though I've been more so on the short side, thinking that we could not break out of this range, the strength is there. And it primarily goes back to, okay, it looks like we had priced in very negative news when we had the biggest historic drop the market's seen. So that's
Yeah,
kind of my take on it and how I see this whole thing playing out right
that's
now.
that's that's a great point. And I want to touch up upon what you just said about having one of the best weeks in the market this last week that we had, even though it was a shortened week, right? Because it was only Monday through Thursday. Friday was a holiday. Um, no, so the one thing I wanted to explain to our viewers is that in bear markets, and until we sort of break out of above this high right here, we're still technically in the midst of a bear market. I guess you can make the argument that once you start crossing that 618 fib, or this area right here around 3,000, then you can start talking about, okay, maybe this is the new bull market. But until then, you're still in the midst of a bear rally, okay? And in the middle of bear rallies, it's very common to see volatile movements up and down in the market. And the funny thing is, we moved up 12% last week, and I think everyone was talking about this is one of the best weeks the market has had since like the 1930s. But if you look back, the other best weeks that we've had in the market have also been in recessionary periods in the 1930s. So it doesn't make any sense when you compare this being the best week in the market when the other best weeks were in the middle of a bear market as well. What's your thoughts on that?
Yeah, I think that plays right to the script of what a bear market is. So exactly what you said. Even though we had such a historic week, I think when you have that much volatility to the upside, it's a really good indication that you are still in a bear market. Because when this market was uptrending, the one thing you saw was VIX was at an all-time low. Volatility was low. But when you still have volatility mixed in, even if it's to the upside, I think that's probably the biggest indication that there's probably still some more room to the downside, because that's what a bear market is. A bear market is essentially just a whole tornado of volatility, and until it calms down, that's when you know that you can start slowly going back up and maybe building into a bull market.
Great point. And I'm glad you brought up the VIX because one thing we explained to our viewers a couple times before is, if you go back a couple of years, I mean, the VIX typically trades between this, 25 level high and this 10-point low. And it likes this trading range. I mean, obviously you see deviations to the downside and upside here and there. But those are usually, some small events here and there, like 2018, 2019, we may have talked about trade war. 2016, it may have been, related to Trump election. So you could see, it spikes up, comes back inside the range, right? VIX still is at a pretty high point right now. And obviously, given the fact that it has not resumed back inside its range, again, we don't expect this to happen right away, but the fact that it has not resumed back inside its range, you could still assume that, we may have some volatile movement, whether it's up or down. Now, one other thing that I wanted to mention is we talked a little bit about the bond markets, okay? And the bond markets being some of the biggest markets in the world, they're usually an indication of what's going on in the under the hood of the economy, right? We talked about LQD and HYG, and for our viewers who are watching right now, HYG is the high yield corporate bond ETF, where they are effectively looking at a basket of junk bonds. Okay, now to simply explain bonds, all you have to understand is AAA is the highest, triple B is, right in the middle, and then below that is junk bond status, where it's the lowest of the, form of bonds particularly. And remember, bonds are related to debt. So when we look at junk bonds, okay, it's effectively the riskiest bonds of all of the bonds. And this means that, companies who are already struggling with their cash flow, companies who may be maybe on the brink of bankruptcy, maybe, really struggling for the last few years, whether it's in their respective sector or their, respective company, et cetera. Yet last week, actually, we saw the high yield growth bonds, which are, again, the junk bonds, really take that spike up because the Fed effectively announced that they're going to backstop any movement, to the downside in the junk bond area. Now, this is important because this sets a new precedent for the Fed, because usually the Fed did not really touch upon the junk bond, the junk corporate bonds. Now, Faisal, like, what is your take on something like this, and what do you see, the Fed essentially stating that they're going to jump into the junk bond area if they have to backstop any of this slide, and what do you think the implications of that are?
Well, first and foremost, it provides liquidity to the bond market that was literally falling just as fast as the stock market was a little while ago. So that's really good. I think it also kicks the can down the road in terms of uh, just how much the Fed is willing to do now and what the long-term implications are in terms of debt and how to combat inflation eventually in 2 to 3 years, 4 years, however long it takes for inflation to pick up. I think it really speaks to the levels of how far the Fed is willing to go to save businesses now. I mean, they're willing to do anything. And I think that's a good time for now, but that makes it even a more risky time and uncertain time for the medium and long-term picture. But on the equity side, so I'm not like a total bond expert, but on the equity side, I did notice something in relation to bonds, which was the XLF, which is the financial ETF sector that I watch. Financials had a huge week this week off the news that the Fed was going to backstop a lot of these investment grade corporate bonds and even cover some of the junk bonds. So that was big news for these banks who have a lot of the debt, who have a lot of these bonds. It essentially, removed a lot of risk from their own assets and portfolios. So you saw companies like JP Morgan jump, 8% on Friday. Citi jumped 9% or 8%, something like that. They all jumped huge Friday, and it was off this news. So I expect this momentum to continue in this sector. And hopefully these banks, now that they have some risk cleared up, they can start loaning more effectively and have more capacity for loans to a lot of these small businesses that definitely need it right now.
Yeah, that's a great point. I had definitely seen an article on Bloomberg talking about, how the Fed is effectively going to do whatever it takes to, backstop, whether it's junk bonds or any particular sector that's struggling. Um, Now, I'm glad you brought up the analogy of kicking the can down the road, because this really does sort of delay the imminent potential downfall that we may have in the economy. Because again, this is something that we've spoken about before, is if you really believe in capitalism and the free markets, right, you can't sort of prop up the entire economy, or I guess major parts of the economy, by central bank intervention or the Fed intervention, by just printing money into the market no matter what for any
Mm-hmm.
company, sector, bonds, etc. Right? It's just not healthy, and it kind of gives a bad picture to the health of the overall economy, because clearly, if within a month, right, of the coronavirus, we can implode so drastically, I think people should really start to question the fragility of the entire American economic system, and maybe even the world, right? Because what we see here, and this is one of the charts that I wanted to pull up, is where was this? Let's see here. I just saw this morning. This was the consensus, 2020 GDP growth. Okay, I mean, we're already seeing GDP across the board fall off. Okay, that's number one. All right. Number two, we're already seeing the global PMI that we spoke about earlier. This is the Purchasing Manager Index for the viewers who are watching. This is effectively how the manufacturing sector, as well as the large scale industries across the world are looking at how the global growth as well as trade is happening. Is it flowing pretty well? Are we seeing lots of movement of importing and exporting across the world? Are we feeling a little bit more secure about the future? This is the one chart that sort of shows that in terms of the global context, right? And you can see overall, I mean, since 2018, it's kind of been taking a drop off, and obviously it plummeted since 2020 started. But I want to let our viewers know that the one interesting thing that we've been seeing across the board is if we start looking at, where is it, the GDP data since 2018 onward, overall GDP was already slowing down. So if we're looking at Japan GDP overall, it was still dropping right here. If we start looking at China right here, China's GDP overall, again, dropping, right? The blue bars right here are America's GDP, okay? If we start looking at India's GDP, okay? Overall, again, dropping. So this kind of tells you that the overall rhetoric since 2018, 2019 really sparked the idea of the trade war that Trump had effectively started. And I don't think that kind of escaped people's minds since then, because I think countries overall are bringing in the narrative of, do we need to sort of nationalize our supply chains? Do we need to bring more businesses back? Do we need to sort of, de-globalize? Are you sort of seeing something like that on your end too, Faisal?
On the equity side, not really. I think you can make the comparison that, yeah, once Trump started his trade war, you started to see earnings estimates come down, and overall manufacturing started to come down because orders became more uncertain. And across the board, there was uncertainty from supply chains and whether or not they would have a strong consumer, and open to the consumer market in China. So there was a lot of, up and down in terms of manufacturing from both those countries. But I think you're kind of right on the nationalizing thing. There could be a front for countries to start nationalizing in terms of keeping goods at home and not relying so much on the US, because I think the US is starting to show that it kind of controls the entire system that everyone plays by. And I could see that it'll take a long time, and I don't think it's an idea that's going to happen anytime soon, but I think the seeds are there for the idea of mass nationalization of key industries for sure.
Yeah, that's a great point. And given the fact that the Fed is essentially, providing bailouts and buying up companies and, buying up the bonds, we've effectively, I think last week we spoke about this, the Fed effectively has put in about 50% of the, overall GDP that the United States has. So the government is essentially, about 50% of the overall GDP, which for the most, I mean, that's a very scary thought, because
Yeah.
that's effectively on the path of, well, the government pretty much, owns everything.
Yeah.
Whether, let's just say the government starts to buy up, the corporate bonds of Ford, right? And if Ford starts to slide out and they start to, put in more stimulus money or anything, government essentially owns Ford.
Yeah.
And this is, again, just one example, right? So if it's Ford or Hertz, I think last week we're starting to declare bankruptcy. I mean, I'm sure there's going to be many companies that are going to start going into the bankruptcy realm. And if the government really starts stepping in and saving these companies, well, if you're saving them, you're effectively, in a sense, buying them. You own a piece of them, right?
Mm-hmm.
You've effectively nationalized these companies in some way. And I think that part gets really dangerous, because when you start nationalizing companies and they become part of the government, the kind of influence that you have on these companies to make certain strategic decisions, again, that's not free market capitalism. That is, the puppet, the hand that's sort of controlling, the capitalism in the economy.
Yeah, totally agree. It's so un-American in my opinion. It's crazy how we've gotten to this point where that's like a very likely scenario, and a lot of smart people think that it should be done. But it's like it's literally the most un-American thing. It's what we've always touted. What makes us great is that we're able to keep government and business completely separate.
Right, I agree. And the scary thing about all this is, I wrote this on Twitter as well as my Facebook, that the amount of stimulus as well as money we're injecting into the corporate side is nowhere close to what small businesses as well as the real economy, quote unquote, the average individual who's lost their job is getting. So the statistic that I read was, for the amount of stimulus that we're putting into the system is about $18,000 for every working American. Of that $18,000 that every tax-paying American, we're adding that $18,000 onto that debt that individual Americans owe. On that $18,000, we're only giving that American back $1,200, and the other $15,000, $800 is actually going out to corporations, the bond sectors, maybe even saving the currency and the credit markets. So in reality, the American worker as well as the small businesses are really the people who are getting fucked, right? I guess what's your take on that?
I guess so. Yeah. When you put it like that, sure. But I don't know about this. I got to see the stat. I got to see the specifics. I don't know exactly what you're referencing, but yeah, when you put it like that, yeah, the American person gets the back end of the saddle.
Yeah, exactly. Now, sort of to add on to that, this is something that I read about the consumer sentiment. Now, one thing we need to understand about consumer sentiment is the American consumer is sort of the highest grade consumer in the world because we spend a lot of money on products. We are the most materialistic society, okay? So we bring in a lot of goods from abroad to consume. Now, consumer sentiment in America is critically important because it ties into not only the stock market, not only ties into people's ability to go out and spend money, frivolously or not, whether they want to go to restaurants or Macy's or go buy a new car, or whether they want to invest in the stock market. All that is really directly tied to the consumer sentiment. And obviously, you've been seeing that since February, consumer sentiment has dropped off quite significantly. And the fact that it's dropped off quite significantly to return back to its, if we're talking about mean reversion, even if it's 70 or 80 points, that's going to take at least a couple of quarters. And this is where we start getting into sort of the multi-quarter recovery that it will take for America. No matter how much the Fed buys, you don't just jolt people back into, quote unquote, the old normal that we had. It's a process. Human psychology has effectively, changed, post-corona. And the jobs themselves that have been lost have effectively changed too, because companies across the board are not going to go from 0 to 100 back to their, original previous, let's just say productivity, right? Is that how you're seeing sort of the market as well, Faisal?
Yeah, no, I think you're exactly right on the recovery aspect. Like you take a look at airlines. You think people are going to want to get on an airline as much as they did before? No. I mean, that demand will slowly start to come back. Sure, you'll see it spike up in the beginning, but to get back to pre-coronavirus levels in terms of the hospitality sector, especially the cruise sector, sure, they could offer competitive pricing, and we'll see exactly what that means. But for the most part, you're right. Like psychology will kind of dictate how consumers rebound, and I don't know if they'll be willing to just pick up and go. Maybe in some instances, like people will stop spending so much on goods as far as Clorox brands or cleaning brands, I'm sorry, or other things that have become a necessity during this time. People will more likely shop for luxury goods or different things. For instance, like I like Nike as a long term because I think right now people are not shopping for shoes, but as soon as this whole virus thing is over, habits like those will start to come back as people still have that money. Hopefully, if this thing does not last for a couple of quarters, if we're talking about the reopening of the economy in May, then I think the consumer will still have enough to rebound fairly quickly to the point where luxury goods will start accumulating, and You will see bounce backs in some sectors pretty fast, but I don't think it'll be across the board like some people are thinking. It's not that simple, but definitely in some industries, sure.
Right, right. That's a great point. Um, Now, I wanted to compare sort of where we are as a country, as a nation, to where the world is, and I guess the parts of the world that are still, sort of dealing with the coronavirus effectively after they've restarted their economy. Okay, so point number one, I wanted to pull up this TomTom data, which is the Shanghai traffic. Okay, now Shanghai is a city that wasn't that significantly impacted, but it was impacted nonetheless. They had some, area lockdowns here and there. Here's something that's interesting about the TomTom data of Shanghai, which is that if you look at the traffic data, the blue line right there that you're seeing, the dash line, is the average congestion in 2019. Okay. Now, if we look at present day, over the last 7 days, we've effectively seen that traffic drop about 60 to 70%. Okay, so now that's just traffic data, right? I mean, even through the week, you've seen drop off. Saturdays and Sundays, when families go out to eat or drink or shop or whatever, you can see clearly that the bar is showing you that it's a significant drop off.
Hmm.
Now that's number one. Okay, number two is that there were some reports in China that even though their stores started back up and life seemingly, quote unquote, went back to normal, they are effectively not seeing the same kind of consumer behavior that they did pre-corona. People are far less inclined to go into stores. H&M specifically, a store in China, saw their foot traffic drop off by about 50 to 60%. So what they actually did was they just said, we're just going to completely close off stores because it's not even worth for us to keep our stores open because we're already seeing, foot traffic delayed or foot traffic reduced by 50 to 60%. So it's better for them to close their stores rather than keep their doors open, to keep their air conditioning on, keep their lights on, pay their employees. So you could see the behaviors even of the retail stores have changed. And on top of that, one of the rules that was set out in some of these cities, even Singapore, was that restaurants themselves, who already run on a thin margin, they were told that you still need to comply by the social distancing rules that we've set out. So that means that they actually had to reduce their tables in the restaurant by 50 to 60%. So imagine a restaurant that already runs on razor thin margins that has effectively been told that if you want to stay open, you have to have 50% of less of the crowd in any given period. So you've already slashed your revenue by 50%. So the point of mentioning all these data points to you is that even the cities that are starting to see sort of these recoveries, you could see that they're really not recovered yet. And even if they are, or they're trying to get on the path of that, human behavior has altered, because you can even see Singapore itself, right? They restarted their economy fully, and then again, they saw that second wave hit, even harder, right?
Hmm.
I think this is the one thing maybe people themselves are scared of too, is there's, fearful that, hey, if we go out to H&M or this restaurant, we might get the coronavirus. So people are now less inclined to even go out. So I guess this is really that whole global problem that we have to tackle as a whole, where unless we get rid of this thing everywhere, and as long as there's, free flow of people or goods across the borders, there's still a scare that we might get the coronavirus again, and people's habits are clearly showing that. Can you expand upon that? I guess I want to hear your mindset on that.
Yeah, first and foremost, I love the data that you provided, whether it was yeah, I like this. It really shows that productivity has come back to China, but like you said, customer habits have not. So kind of touching on what I said before, you will see some sectors outperform, and I think they'll really be tied to, do you have in consumer levels, do you have an online business, and are you strong in that? Because I think people have money right now. There's not that much economic strain. I think people want to shop in China. They want to go back to doing things, but it's that fear of getting it again that I think you're exactly right. I think it's a big risk here. I think the anxiety over here is we want to go back open, and I don't really think we're thinking about the second wave right now. Maybe it's just, in Houston, Texas, but I think if we were to reopen the economy here, people would like, you wouldn't see restaurants cut half their seating. I don't think you'd see that in America. I think you'd see, hey, everything's good back in business, but the likelihood to get a second wave would be high. Like, I still think people would actually go out and act like everything's normal, but
Right.
we would really have a high chance of getting a second wave. And I don't think people will think about that until it's too late. Um, but that's interesting that H&M had to close their entire store. I mean, H&M's a pretty big brand. You would think that, and they have pretty good margins too for being a clothing company.
Right, right, exactly. I was really surprised by that too, because I mean, I've shopped at H&M. They have pretty well-priced clothing. I don't think
Hmm.
their stores are lavish or luxury. So I'd figure that even on their margins, you'd figure that they could stay open, but it wasn't the case. And I just thought, and adding on to my point about other cities and countries restarting, another point that I read about was supply chains in China, right? I mean, number one, they're reduced by, again, same way, right? 50 to 60%. Number two, the world itself is still shut down. So who is buying what you're producing? So you've
Yeah, that's a great
effectively,
point. Yeah,
right.
that's a great point.
I mean, so you've effectively now created a surplus. And this is your, same supply shock that oil went through, right? So if we look at US oil, same thing, right? I mean, oil prices across the board were plummeting, but then they rebounded a little bit. But why the rebound, right? I mean, does it make any sense? Demand is still down. Supply is still, in excess. I mean, Russia and Saudi have created such an overabundance in supply. And even if they slow down by 10 million barrels. I think they mentioned they both slow down by 10.8 or something. Still, I mean, number one, are they really going to slow down? Because remember, these rigs, these refineries, they cannot just turn off and on, right? Especially in Russia, given how cold it is where their oil rigs are, right? They can't just turn on and off, right? So there could definitely be some cheating in that, where they keep their production going. They might cheat by a couple million barrels here and there, or on top of that, even if they did cut, where's the demand, right? Where is the demand to
Yeah.
warrant such a high price in oil? So it goes back to our conversation of China's. Where's the demand for these products in China? Well, there isn't, right? I mean, companies and countries across the board, if everyone is sitting in their house, we're not really consuming. We're eating food, yeah. I mean, we're watching Netflix, yeah. But aside from that, I'm not going out to buy clothes. I'm not buying shoes. I'm not buying anything on Amazon. I'm not doing a whole lot of that, right?
Hmm.
So I guess the point is like, I feel like these countries are effectively shooting themselves in the foot by trying to restart early. And by restarting early, you're effectively endangering more lives and creating a high risk of that second wave, like Singapore did, like Wuhan did again, like Vietnam did, you know?
Hmm. Yeah, and that'll overall affect the demand, for a longer scope than probably what's priced into oil right now. I think the
Right.
bump that we saw was just probably the pre-pricing in of a deal being reached, and I think the United States has said to some of its oil refineries and some of the rig owners that it's okay to close your rig for the first time in forever. I don't know if it's ever happened before, but the U.S. said we are not going to penalize you if you stop operating your rigs. So now that
Mhm.
should ultimately help the supply, cut down the supply of oil a little bit as we're not manufacturing as much. So you may have seen that kind of both those situations bump up oil a little bit, but it's still trading in a very tight range. I don't know if it's going to break out from here, even if we do have a deal. I think tonight we're supposed to get confirmation on what cuts are going through, because on Thursday it seemed like Mexico is at risk of like pulling out of the deal or something. They're not happy with the capacity cuts. So tonight's a big deal. We'll see what happens, and then hopefully tomorrow they can, or tonight they can come to a deal and oil can rally. But you're exactly right on the virus effect. Is the demand is not there, and this, as long as this virus continues to keep people inside, it's it's going to remain there. And like you said, the psychological effects are could pass beyond the virus effect, or at least until we get a proper vaccine. You'll see people not travel as much, not go out as much, kind of be more conservative with their time, and maybe stay at home a little more.
Yeah, that's a great point. I think the one scary thing about America, and I saw this video about how, if you look over Spain or Italy, then there's flights, maybe like 3, 4 flights up in the air. And I think if you look over America, there's like hundreds and thousands of flights. So here's that video that I was talking about. If you look over, you know, let's see, that's Spain right there. You can see just a couple of flights here and there. Italy right there, the boot right there, barely any flights, right?
Yeah.
And we switch over to America. This is America. you know, so I feel like in reality, we're not really doing a whole lot to completely, stop the situation of flights moving, the virus moving, or anything. We may talk about New York numbers going down, but who's to say that New York doesn't spread over to Denver or Denver over to Dallas? Because I mean, there's still a lot of free flow movement of, people across America, right? So
Hmm.
it's just a very scary point that this is why I still believe that even if we start, get the economy back and started maybe in May, we have not completely, number one, figured out a vaccine, right? We have not social distanced enough or had a lockdown long enough to completely eradicate, the spread of the virus for a significant period of time. So it's effectively delaying the inevitable in maybe like a second or a third wave. And this is where, and maybe I'm, I guess projecting a little bit too far into the future, but the way I see it is the one thing that I could see the market being brought down by, aside from the fundamentals that we're already seeing, is that if we start to see that second wave to come in, and I think that is where we might see like that a bigger drawdown back towards this low that we had around 2,100 points, or maybe even lower.
Hmm. Yeah, I totally agree, and I think the market will price in the risk before it even happens. So before you even hear about the second wave, like the market will sell just like it did this time. So um, even if we reopen the economy, that could be like a sell on the news type event if the market really expects, hey, the U.S. has not done the right stuff to prevent a second wave and another onslaught of lockdowns and this problem happening again. So just be
Right.
on the lookout for that too. I think the market has shown that it's going to pre-price in this type of news before it happens.
Yeah, that's a great point. That's a great point. Well, with that being said, is there anything else that you want to talk about, or should we wrap this up?
No, man, I think I'm good. I think a lot happened this week. I think we covered it all.
Yeah, definitely. And again, for our viewers who are watching this right now, we have started our Forex analysis channels, our options, as well as our oil, along with Fasol's awesome equities updates every single day. So I hope you guys come join, whether you want to trade equities, whether you want to trade crypto with us or Forex, come join. The link is below in our website. And I think starting next week or the next 2 weeks, Fasel should be getting his newsletter up and going on the website as well. So you could buy that on the website too. All right. Well, that's it, folks. Thank you so much. Have a fantastic Sunday and be safe.
Peace.